Welcome to the Millionaire Journey Podcast. The goal of this podcast is to guide and empower you on your journey towards financial independence. Here's your host, Glenn Yaney.
Today, my guest is Ruben Izgelov with We Lend. Welcome, Ruben.
Thank you so much, Glenn. And you hit my last name perfectly. I mean,
Great.
It's as though you're a part of my family. Right?
Yeah, I didn't know. I was just going through it. But so I just met Ruben, but I'm extremely excited about interviewing him. He does exactly what I aspire to do when I retire, and it's private lending. And if you could, just tell us a little bit about yourself.
Sure. How much time do you have and how far can I go back? But I guess I'll just kind of jump into a little bit about, me personally and the company. I'm a son of immigrants, first generation. My parents came here with very little to their name. I think my father had about $750 when we moved here from the former Soviet Union. And my father at that time had about 6 mouths to feed, 1-bedroom apartment, 1-bathroom apartment, very humble beginning, sometimes with about 15, 18 people. My sister and I were recounting a couple of days ago, sometimes even 18 people in that single bedroom, single bathroom apartment.
Wow.
So you could imagine what that was like. Fast forward a little bit, when I was about 13 or 14 years old, one of my cousins had this brilliant idea of me joining him door knocking in Queens, New York. And I was 13, 14 years old, knocking on doors. And the whole theory behind why he invited me was because he had a much better success rate in opening doors with a 13-year-old than at that time. I think he was about 35, 40 years old. So it definitely worked. The bug kind of bit me because I was able to witness from literally knocking on a door all the way down to the closing, all the way down to the renovation, ultimately the flip that he's later was able to complete. I think he made on that deal well over $80,000 or $100,000. He gave me a little slither, so the bug had definitely bit me at that time. Fast forward a little bit more, dropped out of high school, thought that school is not for me, which was a huge, huge mistake because at that time, kind of God brought me to the right place to learn the right lesson, which was school is important. School is imperative. So I went back to school, got my GED, went to St. John's University, graduated top of my class, then ultimately went to law school for a kid that actually thought school was not for me. I ended up going to law school, graduating top of my class there as well. But all the while I was in St. John's University in Queens, New York, and in law school, I was buying, selling, flipping, developing properties throughout New York. Predominantly, I would say in the Queens, Brooklyn, the Bronx area. And a little after law school and before studying for my bar exam, my cousin and I, who's now my partner and also a co-founder of We Lend, said, you know what, let's go out to this private lender conference to find a cheaper source of liquidity and also kind of get away from New York before you start studying for the bar. So we went to this private lender conference. We walked in as private investors and developers. We walked out as private lenders. We've never looked back since.
Yeah.
Since then, we've originated a little over $600 million across about, 1,400 asset classes nationwide with zero principal loss, right? We've never lost a dime. We've never lost a penny. And we do manage a 506c. It's Reg D exemption through the SEC. We have a lot of friends and family money, which are near and dear to me. And we're essentially providing financing, short-term capital to real estate investors nationwide. Predominantly on the 1 to 4 unit multifamily and mixed use properties. Our investors are essentially buying physically, financially distressed properties, rehabilitating them, putting some TLC work to it, and ultimately flipping the properties for a profit, usually within 8 to 11 months. We've been doing that for about 7 years now and super, super grateful for the opportunity because, essentially by being a private lender, and I'm sure this is what's attracting you to the space, we're able to hit attractive equity-like returns with monthly cash flows directly deposited into our accounts and later deposited into our investors' accounts while being in the safest part of the capital stack. So what that essentially means is that being a private lender, before anyone takes out their equity, right, their blood and sweat and tears, the lender is always repaid first. We're not hitting returns in the 40, 50 percentile, but we're essentially able to hit, high teen, mid-teen returns on the investment level, and as a result, getting our investors some mid-teen returns as well. So that's been something that we're super grateful for. Happy to delve into anything specific or go into any other topic as well.
Yeah, the thing I love about the private lending aspect of it, for one, is it's as close as it can get. Like when they say passive investing and you get into like single family home investing or apartments or of mobile home parks, which is funny because the mobile home parks is always like known as the passive investment, but it's the most actively managed thing I've ever done. It's like I'm like making sure that the residents can keep all their trash in the,
Oh
put it
man.
in the dumpsters, and I could tell you that personally, I write 40 to one lender about $40,000 a month to a lender,
Wow.
and
That's
I
a
look
tough
at
pill
that
to
check and I
swallow.
think I wish that it could be me on that other side of that check.
Well, there's a lot of, I guess, the misconception in every business, right? I mean, even in my business today, I look at other kind of avenues, and you and I were talking about that right before we started recording. The grass is always greener on the other side, right?
Yeah,
You might view me and say, hey, I wish I can get there. And I might be viewing you and saying, I wish I had, a
yeah,
bunch of mobile home parks and what have you that I'm reaping the benefits of, depreciation,
yes,
appreciation, cash flow, and so on. But on our end, there's a lot to manage as well, right? We have anywhere between 200 to 250 active loans. There's sometimes up to 3, 4 borrowers on every loan.
yeah,
There are partner disputes between borrowers. You got to deal with that, right? You got to say, hey, look, while you guys are having a partner dispute, your mortgage still has to be paid, right? There's construction draws that you have to manage. There's warehouse facilities and credit lines that we have to manage. So I guess everyone has their own kind of demons, for
yeah.
lack of better words, that we're dealing with in our businesses. And we're looking at view other people. And I think that's just human nature, right? Is that we look at other things and we always say, shoot, we wish we were doing that, right? And don't get me wrong, I am super grateful for
Yeah.
where I'm sitting and what I'm doing because, coming to America when I was only 5 or 6 years old, living in that 1 bedroom, 1 bathroom apartment with, like I said, my sister and I counted 18 people from time to time. You would never think that we would be lenders, right? Or even 10 years ago, right? We would never think that we would be doing the volume that we're doing or making the deals with the groups and private equity groups that we're working with today, right? We're selling our paper, we're selling our loans, we have credit facilities with groups that we'd never even imagined to even step foot into or even have a conversation with. So I guess, if you always do the right thing, no matter what it
Yep.
is, you keep your head down, you're laser focused, you're going to kill it, you're going to crush it, and you're going to grow from there.
Always put the investor first, for sure.
Totally,
Yep.
totally. We fight tooth and nail with some of our other groups that we essentially kind of work with to make sure that every penny is accounted for. My in-house controller, Daniel, he is sometimes very tough with the groups that we work with. And he says, "Oh, you guys are shorted us." Sometimes it's like $3, and we get a call from the sidelines like, "Why is he bothering us over $3?" And I'm like, "Well, I get it, but it's the right thing to do because every penny counts for our investors. We are a fiduciary. We want to make sure that we're doing the right thing for them."
If you don't count that $3 right now, it will come back later, 6 months later, wondering where this $3 is, and you will have no idea where it went.
Exactly. Go explain that away, especially since, we're working on our first fund audit. We're making sure that we have a third party that's auditing our books, crossing every
Yeah.
T, dotting every
Yeah.
I, to be able to provide, the transparency that every investor deserves and really wants. Sometimes they don't even know that they need it, but it's something they really, really need to be able to make themselves comfortable in making the investments.
So let's talk about like say your new fund that you're raising for. What kind of assets are you looking for to lend on?
Yeah. So our fund today, while we've launched WeLend about, I want to say 6 to 7 years ago today, I'm already losing count. The fund is about 3 years old, right? Prior to the fund, we were kind of essentially making loans through other groups that we were co-investing with, that we were kind of investing with alongside them, and so on. So we've done about, I want to say, maybe 300 to 400 million dollars of loans with them. And ultimately, about 3 years ago, we decided, okay, it's time for us to launch our own fund. So our fund is about 3 years old now. Today, I want to say most of our assets are residential focused, so multifamily. We'll go up to 30 units, right, on the acquisition, plus we'll provide them renovation money. We'll do the 1 to 4 units, obviously, that's within the 30 units. We'll also do mixed use properties. We've done a lot of condo developments, condo conversions. A lot of our borrowers, especially in the Bed-Stuy, Brooklyn, Bushwick area, they have to become creative, right? The business is not like it used to be, right? Before you would buy something at a very good basis, do some TLC work, and then be able to sell it at a healthy profit. Today, there's a lot more that has to be done for you to be able to break a profit, right? Vertical extensions, horizontal extensions, conversions, or even flat out conversion from a single unit to 4 condo units, right? with a combination of a vertical extension and a horizontal extension. So, there's a lot that we've been doing that we had never done before because we now have the luxury of managing our own money. However, when you are making these loans, you have counterparties that you kind of essentially have to answer to. So, like, although you're managing your own funds, you're managing your own assets, right? You have a healthy, AUM, assets under management. There are counterparties. For example, you have a credit facility. You have a warehouse line from a bank, right? There's banks for banks. You and I kind of talked about that right before we jumped on. That they kind of dictate what they want us to pledge on their credit facility. So they might say, hey, look, you could do a mixed use property, but we don't want the residential or the commercial to be more than, greater in size than the residential, right? To us, that sounds foolish. But if you really look at why they do it, there's a lot of data behind why they want more residential. It's more of a resilient asset class, right? It has kind of stood the stand, the time of many years before, right? Because there's been a lot of fluctuations. There's been a lot of ups and downs. But what really stayed consistent in all asset classes is the residential component of every unit, right? So every asset that you finance. So I think while we have the ability and the flexibility to fund and originate loans that we want, there's still counterparties that we have to answer to. Now, outside of our credit facilities, we sell our loans, right? We work with groups backed by KKR, Goldman Sachs, and Blackstone, BlackRock, and alike that are essentially buying our paper, right? And the reason why we like to do that is for two reasons. We like to sell our loans, one, because we have the ability to mitigate our risk, because once we sell our loans at a 5 or 20 or $30 million tranche, that loan is no longer on our balance sheet, or those pool of loans are no longer on our balance sheet. If there's any kind of market trend or market wind fluctuation, we're no longer holding those loans. So as a result, we're not feeling that risk or that pinch. But also we have the ability to compound our money because every time we sell our loans, we capture a spread. Assuming we sell our loans once, let's just say once every 2 weeks, 52 weeks or 26 weeks, what have you, at a 1% spread, we're able to capture a 20% return versus just holding the loans on our balance sheet and capturing only a 12% return. So there's a lot of ways to kind of skin, and operate in this business to be able to hit attractive returns to our investors while also always having risk mitigation at top of mind. And I think I kind of diverted into a whole different topic. I think you asked me about asset classes, so forgive me, Glenn.
No, it's okay.
I tend to do that. Don't ask my wife because she'll probably agree with me, but I tend to go into different topics and different discussions, but I think your question was really about the asset classes. And today we like to focus on units between 1 to like 30 units with mixed use components as well, with residential being a higher percentage of the square footage.
Hey guys, if you want to learn more about our deals we're investing in, go to our website and sign up for our free ebook, 10 Reasons Mobile Home Parks Outperform Other Real Estate Investments. We won't spam you. We'll just keep you updated on the podcast and the deals we're working on. Now, back to the show. So let's talk about the debt that you borrow to lend. So like generally, you're securing the asset as in like, we'll just say a single family home. You're offering a loan of like, what kind of percentage? Like 12, 15?
Yeah. So, I'll kind of break that down for you a bit more. So we will, let's just say it's a single unit property, right? Just to kind of make
easy.
Do it easier. Yeah, make it easier. Single unit property, depending on the borrower's experience, depending on the acquisition, will go up to 90% of their purchase price.
Yeah.
Will go up to 100% of their construction. Now, that's with the caveat that they have the experience, they're institutional grade, they have good credit, they know what they're doing. We won't go up to 90% on the first time that we're lending to a borrower. It's someone that's probably already brought us a lot of business. We've seen their track record. We've seen their execution. We know how they work and so on. But generally, we'll go up to 90%, 100% of the construction, 90% of the purchase price. And what we'll do after that is we'll have the ability to go to a bank, right? And we'll, I don't want to name names, but let's just say there is a private credit group that we work with today. I think they're managing right around $4 or $5 billion. Institutional, they have some endowment money and so on. They will provide us a warehouse line, but they'll also provide us the flexibility of buying our loans, right? So in the event that we put a loan on the credit facility, they'll give us about a 75% advance on our loan. So let's just say we make a loan for $1 million. We'll have the ability to pledge that $1 million loan and get back $750,000. And that $750,000 will enable us to hit a return of about 20%. The reason why, and again, I can go into more detail about it, but the reason why is because we have the ability to arbitrage that 750,000 multiple ways, right? Their cost of capital to us is 9%, but the cost of capital to the borrower is 12%. So that additional 3% on that 750,000 enables us to hit about a 22% return for our investors on the investment level.
So
Complicated stuff.
no,
You
yeah,
sure you
it's
still want to be a lender?
no, I love it. I love it. I was just trying to figure out um, how do you go about finding the people? Do you find other loan brokers and stuff that
The
locate
borrowers?
you? Is that
Yeah,
how that works out?
it's a very good question. So, when we started, we had no borrower base, right? It was a new company. It was just me, Moses, and Solomon who kind of launched this, had an idea, walked out at private lending conference and said, we're going to do this, right? Because it just attracted us because of the safety involved in investing in a fund in debt versus equity. So what we did at that time, the only thing that we had was our phone book, right? Our contacts in the business. Essentially our friends, I still to this day consider every single one of my friends. They were also our competitors, right? We had friendly competition, you could say.
Yeah.
These are guys that I know that were bidding on the same properties that I was bidding on when I was still a fix and flipper, right? So we called them and we said, look, I know I was bidding on 123 Main Street against you a couple of days ago. But I'm no longer a real estate investor. I'm taking off the real estate investor hat and I'm putting on my lender hat. And I want to become a lender. And I want to lend to you because I know how you execute. Yeah, you may have not liked me or I may not like you, in a friendly way because I bid on one of your properties at the foreclosure auctions. But you know what? I want to be able to lend to you because I know you can execute, right? So we kind of started there, right? We went straight to our phone contacts, phone books, friends that we knew were in the business, and we said, let us lend to you. Because those are the guys that we know the business. We know that they can execute. We know them from the community. We know them from the neighborhood and what have you. But then eventually you kind of tap out, right? You got to figure out other ways of
Yeah.
bringing in business. And that's where really social media kind of helped us catapult. And that was a catalyst to where we've actually gotten to today. So we started jumping on a lot of podcasts like this, right, Glenn? I mean, this is an amazing podcast. I was listening to a few of your shows yesterday. You do an amazing job. You have a very good following. Viewers
Thank
are
you.
listening and tuning in. So podcasts were a big part of how we were able to grow our borrower base, but also Instagram, LinkedIn, TikTok, right? I mean, I
Yeah.
know there's a very big, kind of question of what's going to be happening with TikTok, but TikTok also helped us bring in a lot of business. So I think today, as of today, we're 2025, March 2025. I want to say the bulk of our business is from referrals. The bulk of our business is from returning borrowers. We have about a 70% returning rate from our borrowers and about, I would say, 60% referral rate from our existing contacts today. But before that, it was really the social media, podcasts, and alike.
Awesome. And where do you just totally lost my train of thought. But
Yeah. I know you said that you're investing in mobile homes.
yes.
Where are you investing? How's that looking for you?
We're investing where nobody wants to invest is in Central Florida. So
Smart.
yeah.
Smart. You
No,
go
we
where no
love
one
it.
else is going.
Yeah, no, it's we had a couple bad hurricanes this past year, but it's thankfully what I'll tell you about the hurricanes is that the houses took on more damage than our hurricane part, like at mobile home parks, and the with to fix a mobile home compared to fixing a house, it's a lot easier to fix a mobile
Right.
home. It's
Right.
cheaper material. We have the people on staff to fix them. We had a couple bad things, but one of them was a tree sawn through a trailer,
Oh, wow.
and I
I
mean, we
hope no
had
one
it.
got hurt.
Thankfully, nobody got hurt, but
Yeah.
replaced it, not replaced the trailer, but we completely repaired it. It's all like stick wood frame, so we
Right.
fixed them and had them back in the house within a week. So it's
Goodness.
compared
You can't do
to
that with a house.
yeah, with a house, we saw some pretty gnarly stuff. There was trees. If a tree speared through the house, the house is going to be down for a couple months at least.
Totally. Totally.
But yeah, so yeah, we
Are
we
this
deal we deal a ton with private money lenders.
right?
Almost every deal we buy is a private money lender, just because we buy a lot of value add,
Mm.
and that's why it's so important to have, especially if you're in real estate investing. Um, you have to be creative. You can't just be buying, with conventional banks. Like, because if you're
Right.
able to do that,
Right.
the meat's probably already gone. There's no, you're
Right.
not going to be able
Right.
to. What we're trying to do is make it financeable. And
Right.
I had another operator on the other day, and he pretty much Ryan Norris, and he said he just refinanced a large portfolio of his, and the thing that everybody tells us is to not we buy a lot of small stuff, 10, 30, 40 unit parks. And apparently they're harder to refinance. But he says if you run them like an institution, they will treat you like an institution.
Right.
and
Right.
that's what he did. He wrote he got a very large loan for 2,000 units. And
Wow.
with mobile home parks, uh, they're not making any more. So I think banks are wanting to lend on them, but they just need to find the good operators is what it comes down to. And that's kind of what we're trying to fix, just try to get bad operating parks to good operating and then get
Right.
conventional financing. But we get it through private lenders. So they're super valuable partners of ours. If without them, we couldn't do what we're doing today.
And do you guys own the land that you guys are actually?
Oh, yeah.
Yeah, you guys do.
Yeah, so
So
we
it's
bought
the land and the mobile parks that you guys own.
Yeah, so the part that makes them unfinanceable through conventional financing is the mobile homes on the spot are park-owned homes, and the banks want to have insurance on the mobile homes because they're making income.
Right.
But the problem is you're in Florida and they're older homes, so you can't get insurance on them. So
Goodness.
it makes the income not protected is what happens. So there's ways around it, like income protection insurance that you can get. But overall, these parks are just in really rough shape. It's hard to get income protection on certain age homes because even those insurance companies don't want to insure the parks. But yeah, so private lenders are very important to what we do. And when you were talking, I was actually thinking about it, is that with interest rates going up, it makes it so much more valuable to have private lenders just because,
Totally.
and it makes it more feasible for there guys that I call them competitors. They're not competitors. They buy parks next to ours. We know each other, but
Friends.
they couldn't figure out how to buy parks with high interest rates. We've always paid high interest rates, like through when rates were 2% and 3%. Like everybody's buying mobile home parks. We couldn't figure it out how to buy them conventional at that time. But now that rates are up, private lending's coming out, which is, in my opinion, great. It's like leveling out the wealth. It's like it doesn't all go to like one bank or four banks. It actually goes to the people like you and me that are able to take our own dollars and put them into a private money lending fund and
No, you
fix
hit
up
it on the head.
things that normally wouldn't be fixed up.
Yeah, no, I think you hit it on the head. I mean, the delta between the rates that the conventional, kind of paper banks are writing
Yeah.
versus the private lender has really compressed, right?
Yep.
And because of that, I think a lot of our borrowers today, they think the same way you're thinking. They're saying, you know what, instead of me having to go through this due diligence of underwriting and all this red tape with, some of the major banks out there, I'd rather, work with you, pay a little, delta, say above, maybe sometimes usually it's about maybe 3% more on annualized basis. But I know that I'm going to get the loan. I know that it's a very high rate of execution. I don't have to go crazy looking for documents and preparing documents. Yeah, there is some underwriting with us as well, right? We are a steward of other people's money. We're managing 506C, like I've mentioned before, majority friends and family money. So it's as though it's my own money, right?
Yeah.
Every dollar that goes out, we want to make sure the T is crossed and the I is dotted. And that's why one of the co-founders of the company, who's also personally invested alongside me, is Moses, who underwrites every single loan. So before a penny goes out, he makes sure that the loan makes sense. So, while there is still underwriting involved on our end, it's not as extensive as, say, a conventional bank, right? Now, a lot of our borrowers today, they're buying properties for short term, right?
Yeah.
They're buying, fixing, flipping. But I think a lot of the groups that are also buying with the intent of holding the properties, they still view it the same way as we just discussed, right? They're saying, hey, I'd rather buy this property right now with you. I might even get a discount on the purchase price because I'm able to close much quicker with a higher rate of execution. There's no mortgage contingency, and as a result, I'm able to get a discount on the property, which may somewhat cover the cost of my delta on my interest rate. But then eventually, once I stabilize the property, I make sure that it's producing income within that 8 to 11 months, 12-month time frame. I'll refinance. I'll have all my paperwork and my ducks in a row to be able to do that at that time, and I'll have an income producing property, which really kind of expands and opens the horizon as to how many groups or banks you can actually go to. Because I think one of the biggest challenges outside of the fact that the property might be physically distressed is that it's financially distressed, right?
Yeah.
So if you're able to buy a property, fix it up, make sure it's producing income, it's rent rolling, it's actually profitable, you now have a higher chance of getting a very good loan, than you did, say, 8 months ago when you were buying the property.
Definitely. Yeah, so we just had an interesting one. So we went through a private lender where the lender is our familiar lender. He's kind of familiar with us. So he's willing to overlook some hair on the deal.
Right.
But we ended up, what we learned through this process of buying mobile home parks is that you can't own park-owned homes. So we still had to, his term was expiring, and he's not the kind of cash out lender that you wouldn't go to him and ask for more cash later on a loan. So we had to go to a new private lender. But these lenders are way bigger. They had like a $300 million fund. And but these guys, what I'll tell you about working with private lenders is that you're like talking to a person that's actually making the decision a lot of times. You know, you're
Right.
like having a conversation with them. You're not like too worried about it falling. You know, you want to make sure
Yeah.
that all the information is correct, but you're not too worried about it falling apart for some random detail, which I can tell you that with regular
Totally.
banks, the person that's
That can
underwriting
happen.
your loan, they just want it off their desk.
Right.
and
Right. No,
and
you hit it on the head. You
you
hit it on the
know,
head. So, you're usually either speaking to a decision maker or a
yeah,
person, one person removed from the decision maker, right? I
yeah,
mean, they could, like today, I'm one of the decision makers in my office. We have, I think collectively, about 30 to 40 people that work with us. Anyone can walk into my office with a deal and a scenario and discuss it with me so we can make a decision, right? With a bank, you can't do that.
no,
You're not going to walk into Jamie Dimon's office and say, "Hey, I got this $200,000 property in West Alabama or something like that, and then I need financing on it." It's not going to happen, right? But with private lenders, I think you can really kind of think outside the box. I think you can really structure deals that make sense, and you could really get a higher rate of execution and financing than you were with a bank. Now, this is not to say banks are not a good conduit. They
yeah,
are, right? And they should be, and they should be used. And I always
yes,
tell, my borrowers, like, look, you come to me only if you need me, right? If you can have a bank finance you and you have the time and the flexibility to be able to get that financing and you have, you're that A paper, you have perfect income, you may have a full-time job or W-2 somewhere else because that's what banks like to see.
yeah,
You should go that route.
yeah,
But if you don't, you got to come to me, right? And then you go out and you take out the loan through a bank statement loan, you take out the mortgage that I gave you through a DSCR loan or something like that, where the property is now producing income. So you have so many other avenues of financing than you did before.
definitely. It's just the cost of doing business.
Totally. You know, you hit it on the head. When I was fixing and flipping, I used to borrow from a true hard money lender. I mean, he's actually an investor in our fund today. We've remained friends for so many years, although I stopped using him before I even stopped financing. Before I stopped, when I started financing deals, obviously we were focused on lending. He was a mentor to me, right? But at that time, you said it best. The cost of doing business, I was being charged 15% with like 4 points.
Yeah,
But what I liked about my private lender then, and I love him till this day, was the fact that he was able to give me advice. He was able to give me contacts. He was able to give me attorneys. He was able to give me GCs, subcontractors, and so on that no one else was able to provide. So for me, yeah, there was a higher rate of doing business, but I was certain that with him being behind my back, right, providing the financing, and now he's incentivized to close to make sure that I'm a success. With him being behind my back and in my corner, I had a higher rate of execution. So, when we really experienced that in, what was it, 2011, 12, 13, we really took that home. So when we launched WeLend, we said, okay, everyone can compete on terms. Everyone can compete on rate, right? I can probably be, maybe 25 basis points cheaper than the other guy. But there's one thing that no one else can really compete on, and that is service, right? And that's something that we really, really take home with us. We'll compete on terms. We'll give you a lower rate. But one thing that we will always consistently provide you with is the service. Every single one of our loan originators, every single one of our underwriters, we don't have landlines on our desk. We only have cell phones, right?
yeah,
So that's the key thing and differentiating factor between us and other private lenders, that they all have this, 9 to 5 gig. They have a landline on their desk. And if they're not at the desk, they're not answering. No way, right? Every single one of my guys, the only time I tell them that you can't answer is if you're being intimate with your wife or if it's a religious holiday for you. That's the only time you shouldn't be answering the phone, right? Otherwise, I want you to answer your phone if a borrower calls. So shout out to every single one of my loan originators and underwriters and processors that really take that home and have made it their culture to make sure that not only do we lend, but we also answer the phone call.
It's half the problem or half the solution, I guess, is really what it comes down to.
Totally.
Answering the phone and just having good communication is always very important.
Oh, yeah.
So if you could tell us where people can find you.
Sure. They can find us on our website, www.welendllc.com. They can also find us on all major social media platforms, TikTok included. Hopefully, TikTok will stay around. Our handle is We Lend LLC. They could also always reach me at my cell, 917-815-1222.
Awesome. Thank you so much, Ruben, for being on the show.
Glenn, it was a pleasure. Thank you.
Thank you for listening to the Millionaire Journey podcast. Please rate, like, subscribe, leave a comment, and share with somebody you think would enjoy listening.